Isn't that fascinating? The reason why Bitcoin has a hard time climbing is because both the whales but also the small retail investors stopped accumulating. What we see here at the bottom, that's the Bitcoin price. What we see at the top is the trend accumulation score. Now this is by cohort, as in the wallets that have less than 1 Bitcoin are at the bottom. We go one order of magnitude up for the next bar, so that's 1 to 10 Bitcoin, then up to 100, up to 1,000, up to 10,000 and above 10,000 Bitcoin. So when the top line here, when the top row is red, it means that the mega whales, or potentially the centralized exchanges, they stopped buying. When this is blue, they are accumulating. Interestingly enough, the mega whales and the small retail investor tended to do the exact same thing in the last 2 to 3 months. There was a lot of pessimism at the beginning of the year. All wallet cohorts sold their Bitcoin. Then some whales started entering. The retail investor followed. The whales dumped on retail purchases, and now the whales and retail trade in sync. They seem to be doing the exact same thing, which is unfortunately not buying. That's an interesting metric you've probably never seen before, and that's the sell-side risk ratio. So this looks at the conviction of sellers in Bitcoin. When this is very high, then the sellers are realizing a lot of price change. So for example, when we rally a lot, they're mainly taking profit. When this is very low, then the buying and selling price was relatively equal. So there wasn't a lot of loss or profit realization. What's interesting is that whenever this peaks, we also tend to stop a medium-term rally. We tend to afterwards rather correct. Currently, we are very low on that sell-side risk ratio, which can be interpreted positively for the future price development of Bitcoin. Really, the price dynamics in crypto have changed a lot since the introduction of the ETFs and since the treasury companies are buying. Because of that constant buy pressure, we tend to see higher highs over the long term. It's not just the expansion of fiat currency, it's not just more dollars floating around, it's also a constant buying pressure from Wall Street that reduces the circulating supply. Here is the weekly US spot ETF net flows. It's a chart that starts at the end of March of this year, and we see purchases in the vast majority of weeks. Maybe without the ETF, we wouldn't have seen Bitcoin rise from 85K to more than 120K. When we look at the Bitcoin purchases in the last month and we annualize this, so we pretend that there will be the exact same kind of demand in the next 11 months, then we will have more than 3% of the entire Bitcoin supply getting purchased through Wall Street. Right now, 6.68% of the Bitcoin supply is held by the ETFs. And again, this currently grows at 3.13%. So relatively speaking, the ETF ownership will grow by roughly 50% in the next 12 months. Again, if purchases continue at the current rate. And this is actually a pretty good assumption, because have a look at how constant the purchases through the ETFs are. This is the number of Bitcoin that was bought via the ETFs since the beginning of 2024. And yes, there are some months where we don't see as many purchases as other months, but in general, the trend is very, very clear. And again, this starts at the beginning of 2024. At the time, Bitcoin was at around $40,000. And the price has roughly 3x'd since then. But the rate of purchases measured in Bitcoin did not slow down that much. In other words, the amount of US dollars that flows into the Bitcoin ETF also 3x'd during that time. Otherwise, the number of Bitcoin that's held through the ETFs wouldn't grow at that rate. Now, 3.13% supply absorption might not sound like much, but it does matter when we put this into perspective, as in how much new Bitcoin actually gets mined every year. That's only 0.84%. And this will even get cut in half in 2028. So more and more Bitcoin gets stashed away. It becomes a less and less liquid asset. It's not just becoming rarer and rarer because of the halving, it's also becoming rarer and rarer because there are entities that tend to just buy up more Bitcoin with rarely taking any profit. despite an almost 3x price increase since the introduction of the ETF. Here we've got a combined view, a longer time frame. Here is the ETF introduction, and before that we had the grayscale Bitcoin Trust. On top of all of that ETF demand, we also have the treasury companies that also continue to buy. They also take up more and more of the entire Bitcoin supply. They tend to even buy a bit quicker than the ETFs do since the beginning of the year. So it might make sense to even double this number. That is maybe not just 3% that gets purchased through Wall Street, but maybe 6%. Treasury companies plus ETFs. So let's make a quick back of the envelope calculation. How much rarer Bitcoin gets over time. We've got our 6% that gets bought through the ETFs and through the treasury companies. We've got a supply expansion of a bit under 1%. So that's not really great. That doesn't really help the price. But then we also have the Bitcoin that gets lost over time. So here is the Bitcoin that hasn't moved for the last 7 years. And this also tends to monotonically increase. Yes, there are sometimes people that are able to revive the forgotten Bitcoin, but over the long term, this also seems to almost monotonically increase. Let's look at the last 6 years. We had roughly 10% of Bitcoin supply that got lost over 6 years. So that drives down circulating supply by another 1.6% per annum. So that's actually good for the price. Now, what other effects can we think about? How about the fiat debasement? Since there's more and more dollars that float around, that should also have a positive impact on the Bitcoin price. It had positive impacts on any price. Stocks go up, gold goes up, property goes up, all just because the monetary base is going up. How quickly is it going up? The answer is 6.8% per annum. So this is how quickly USM2, the monetary base, expanded over time, and the growth is relatively constant. There are times of quicker expansion and times of slower expansion, but in general, 6.8% is a relatively reliable number. So that of course helps the Bitcoin price as well, the US dollar devaluation. So let's add up all of those numbers. We get a minimum long-term price appreciation of Bitcoin of 13.4%. All the trends that we looked at were very consistent. Bitcoin continues to get lost. Bitcoin continues to get purchased through Wall Street. The US dollar continues to see devaluation. Now, 13.4% isn't massive, as in most estimates think that Bitcoin rather appreciates by 20 to 30% per annum. I tend to agree. And that's because of the following. When the circulating supply contracts that quickly, so net by 7.6% every year, then that will push up the price by more than 7.6% because there is inherent leverage. $1 invested into Bitcoin increases its market cap by more than $1. Again, because not all Bitcoin is liquid. Think about it this way. Let's make an analogy to property. Say you had a street with 100 houses, and all of those houses are exactly the same. And all of those houses sold for $1 million, or they've got a value of $1 million. So then all of the houses on the street are worth 100 million. Now let's say somebody wants to move to that part of town and wants to buy one house, but nobody wants to sell. Then one person might say, okay, I am willing to sell my house for $2 million. What happens then to the market cap of the houses on that street after that transaction? All of the houses will be valued equally, right? All of the houses suddenly have a value of 2 million. So we're increasing the market cap of the houses on the entire street from 100 million to 200 million, even though we only saw a transaction of 2 million of a single house. So it's really about liquidity. We can think the exact same way with Bitcoin, right? Instead of having 100 houses, we have now 21 million Bitcoin. Every Bitcoin is exactly the same. If only one person is willing to buy it for a higher price, the market cap skyrockets. And the more liquid Bitcoin is, of course, the slower this price appreciation happens. But over time, Bitcoin becomes less and less liquid, again, because of all the factors that we talked about in this video. Thus, there is a case to be made that maybe long-term, we do not see diminishing returns. As in the early days, Bitcoin appreciated extremely quickly, and now it tends to appreciate less quickly. But maybe as Bitcoin supply gets less and less liquid, we might see a sudden breakout and maybe Bitcoin suddenly trades not for 100k or for 1 million per house, but maybe then suddenly for 200k, for 300k, until people are willing to sell their Bitcoin again. Yes, there is a lot of noise and we can try to time the bottoms and the tops, and I try to do this as well. But despite all of that, we should not lose sight of the long-term trends. What really matters is that over time, Wall Street is buying more and more Bitcoin through the ETFs and through the treasury companies. Those trends are very constant. The supply will not increase. That's very different to other assets, right? When gold becomes expensive, there will be more gold miners. When property becomes very expensive, more people will buy houses. When companies become very expensive, then venture capitalists are more willing to finance new ones. But when Bitcoin becomes very expensive, there will not be more Bitcoin. Bitcoin has a fixed supply expansion rate, and that expansion rate is lower compared to the rate at which it gets lost, which is roughly 1.6%, double of the mining rate. There's no doubt that long-term Bitcoin will outperform most other assets. There's also quite a bit of volatility, but if we don't see any catastrophic event, like let's say Bitcoin ETFs becoming illegal, or let's say the treasury companies having to sell their Bitcoin, if the current trends just continue, then the appreciation of Bitcoin will be at least 13%, probably because of further adoption and because of price sensitivity, rather 20 to 30%. Because when we've got an asset class that appreciates more than most other asset classes simply because of fundamentals, then this will of course also help with adoption. This will help to spread Bitcoin as a diversifier in a broader portfolio. Now there's a very interesting misconception with altcoins. Have a look at this chart here. This shows total 3 ES divided by Bitcoin. Now what does this mean? Total 3 is the market cap of all cryptocurrencies that are not Bitcoin and Ethereum. ES means that we also exclude stablecoins. So this is all of the volatile altcoins that are not Bitcoin and Ethereum. And we look at that market cap relative to Bitcoin's market cap. So how are the volatile altcoins doing relative to Bitcoin? And it seems like this is trading in a range in the last 8 years. If we just look at the prior year, we also seem to just performed in the same way as Bitcoin. But clearly that is not true. Have a look at the performance of these smaller altcoins in the last year. Pretty much everything is red while Bitcoin went up. The key to the puzzle is to understand the difference between market cap and price. This here is an example of WorldCoin. WorldCoin over the years saw an increasing market cap. It went from a peak of 1.5 billion to 2.5 to more than 3 billion. So WorldCoin tended to grow in market cap. But have a look at the long-term price chart. It looks very different. WorldCoin's price peaked at close to $10 and is now below $1. There can be a massive disconnect. In this chart here, it just looks at the altcoin market cap relative to the Bitcoin market cap. And this is true for many altcoin related metrics. It's true for the others market cap. It's true for the others dominance. It's true for dominance charts in general. When we look at the Bitcoin dominance or the Ethereum dominance, we are just comparing market caps. We are not comparing prices. Even when the Bitcoin dominance stays stable, Bitcoin very likely has outperformed most altcoins because altcoins might have been stable in market cap, but they might have gone down in price. This effect that we see for WorldCoin is very typical for altcoins. Now here's the circulating supply of WorldCoin. Again, just an example of what's going on with the market. We had 500 million WorldCoin at launch, and that more than 8x'd over the span of 2 years. When we look at the entire altcoin market, at least the tokens that are tracked by Tokenomics.ai, we've got weekly unlocks of roughly $1 billion. So if the demand for the altcoin market is below $1 billion, if the altcoin market doesn't grow that much every single week, then the price goes down. Because all of those unlocks, they are tokens that get allocated to the early investors of the altcoin projects. They get allocated towards the founders. They get allocated towards the insiders. So they are cashing out at a rate of 1 billion per week. And if the retail investor doesn't buy at the same rate, then price goes down. So here is an example. This is WorldCoin in US dollars. Here is WorldCoin relative to Bitcoin. So a much more consistent underperformance. Now there are two potential takeaways from this. The first one would be to just completely stay away from altcoins altogether, altcoins are rigged, altcoins are through dump on retail investors. But the second potential takeaway is to maybe flip this thing around. So we are betting on falling prices of WorldCoin, while at the same time betting on rising prices of Bitcoin. So when we flip this chart, we get this here. This looks quite interesting, doesn't it? Since launch, Bitcoin outperformed WorldCoin by 836%. So that's the kind of performance we are looking for. The problem, of course, is volatility, especially here at the end. So WorldCoin occasionally does have positive news. It still has development. It's still an active project. And so a strategy like this can still lead to temporary drops of 55%. Despite the long-term outperformance. So the idea to bet on token inflation structurally is a good one. The idea to bet on falling prices when things look like this is a good idea. But risk management is crucial, and we have to look at assets that don't have that much more active development, where we don't see any positive news around the project anymore. Here's an example I like to give regularly on this channel. This is Bitcoin relative to Balancer. Balancer also has a high token inflation. And yes, there can be some drawdowns along the way as well, but they're not 50%, they're only 30%. And on a logarithmic chart, this looks much more manageable. And so this strategy doesn't just work in theory, it actually does work in practice. Let me show you how. When we look at this relative valuation chart of Bitcoin to Balancer, and we compare this to just buying and holding Bitcoin, so that's now the line in orange, we can clearly see how betting on the differential, so betting on falling Balancer prices by betting on rising Bitcoin prices, has a way better long-term risk-adjusted return. And so I followed this strategy for the last 4 years. This is a monthly chart. Had I just dollar cost averaged into Bitcoin, I would have gotten the performance here in light gray. But because I also bet on falling altcoin prices at the same time, I got the performance here in black. Now the problem is, just because I make profit with that strategy doesn't necessarily mean that you have to make profit with that strategy. But I do believe in the strategy that anybody can mirror similar performance. What we've got over here is a copy trading vault. So the premium members of this channel had the possibility to invest in a capital pool. That capital pool is closed until the end of the year. But anybody that deposited in July of this year is now up roughly 20%, while Bitcoin since then went down in price. Of course, the massive market disruption that we saw recently helped us as well. It was actually the best weekly return ever. It brought us more than 9%. Most others got wrecked, but we made money. And so I made several videos on the topic. There's one video explaining the copy trading vault, but again, that vault is closed until the beginning of the year. But here are the two more important videos: using perpetual futures to bet on relative valuations, and risk management with relative valuation bets. Risk management is extremely important, because if you don't know how to do that, you get wrecked during volatile times. You don't make money. So here are the two videos. This is 34 minutes in length. Here's the other video, 28 minutes in length. And once you've watched those two videos and you've joined the premium groups, I will share my favorite trade with you. So the favorite trade will look very similar to the Balancer trade that we looked at. If you are not making money with that favorite trade after holding it for 1 month, I will refund the premium membership fee to you. So really, you are not risking those $125 US. If you're not making money with the trade, you just get this refunded. I will not ask any questions. If you want to be part of the next copy trading vault and you don't want to make the trades yourselves, you simply just want to deploy capital, then feel free to check out this video over here. This was the introduction to the vault from July. And feel free to consider to sign up for the annual membership, because the yearly subscribers, they get access to that copy trading vault that currently is closed. Of course, you can simply start out with monthly, start the trading yourself, and then swap to the annual membership later on. A link to premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.